Hey there, welcome back to another video where we pull back the curtain on the corporate world. We always hear about how the rich use loopholes to avoid paying taxes and laugh all the way to the bank. And by the way, if you didn't know, tax avoidance is actually considered legal while tax evasion is not. More on that in just a second, but in today's video, I'm going to attempt to break down and explain just a few of the loopholes the rich use to stay rich. And hopefully by the end of this video, you'll be able to see how businesses, yes, even your own employer, can use these completely legal yet pretty controversial methods to avoid paying their taxes. And by the way, let me be clear, this isn't financial advice or legal advice or tax advice. Always go speak to the proper professionals. This is just information I've come across, and I thought this stuff is pretty interesting, and I thought you would too, so I wanted to share it with you. Okay, so back to tax avoidance versus tax evasion. Although both sound like something the IRS would frown upon, tax evasion and tax avoidance are very different things. Here it is from the IRS themselves, if you don't believe me. This is from apps.irs.gov. If we come down to the key terms here, we can see tax avoidance, an action taken to lessen tax liability and maximize after-tax income. And below that we have tax evasion, the failure to pay or deliberate underpayment of taxes. In the summary section, tax evasion is illegal. In contrast, tax avoidance is perfectly legal. The IRS regulations allow eligible taxpayers to claim certain deductions, credits, and adjustments to income. Now referenced here are common personal deductions you can take whether or not you own a business or you're a salaried employee. But when businesses get to tax avoidance, they take deductions to a whole nother level. I'd say some of these deductions have a gray area so vast it looks like an overcast sky on a rainy day. And most of us don't know about any of this because, well, we aren't really in a position to leverage them. Some of this stuff requires millions of dollars just to be able to take advantage of it. So let's take a look at some of the strategies the wealthy and big business owners use to lower the amount of taxes they have to pay. But before we dive in, I'd like to take a moment and thank our sponsor for this video, Extra Wallets. That's right, they're giving me a second opportunity, and that's because of you guys. So first and foremost, I'd like to say thank you, really. I figured it was good timing, seeing as we're just about to discuss how businesses protect their wealth. Extra's here to help you protect your own. You see, Extra produces some pretty sleek wallets. This is the one I use. It has an AirTag so I can track it if I lose it, and then it has this button here. If you press it, all your cards fly out. It's super cool to show your friends and family. They're like, wow, what's that? And you're like, yeah, I know. Every time. And this little mechanism right here, it's never worn out. It's never gotten stuck. Never had any problems with it. But not only that, the footprint of it is pretty small, so you don't have that huge bulge in your pants when you're walking around. Now, like I said, the wallet I use has the AirTag in it. They have other wallets that come with its own tracker, and it's solar powered, and then you can use that to find your wallet if you lose it. I just use AirTags because I track all of my dogs and a bunch of other things with it. It also comes with some RFID blocking technology, so if people try to steal your credit card information, like walk up behind you, try to scan your stuff, they can't get it. So you can rest assured that your card information is safe and sound. Now, if you're into the everyday carry thing like I am, they also have a few other accessories like a 7-in-1 tool card, a key tracker, a cash clip. You can get the whole setup, but keep it minimal at the same time. They make a few different types. I have the leather wallet. They also have an aluminum wallet, a carbon fiber wallet. So if you're curious about picking one of these up and you want to wow everyone at the next get-together, you can check them out by using the link in the description. And be sure to use my code Fluke for up to 35% off for the Father's Day sale they got going. And let's be real, this is a pretty cool Father's Day gift. Just saying. I've actually converted HR Lady's father into an Extra user. Anyways, thanks again, Extra. Go support the people who support me. But now let's get back to our regularly scheduled programming. Okay, so the first one, the double Irish arrangement. It's convoluted but clever, so stick with me. The TLDR is that companies move money to themselves overseas by saying they bought or leased intellectual property from another company in another country. But again, it's their own company and it's their own intellectual property. See, the double Irish arrangement is a tax strategy that involves moving profits from a company in a country with higher taxes to a subsidiary sister company in a country with lower taxes. Let's say you and your friend decide to set up two companies. You open a company in a high tax country and your friend opens a company in a low tax country. And usually these days, it's the country of Ireland that companies like to use, or even the double Dutch sandwich as they call it, because they'll move money multiple times through the Netherlands and then to Ireland and then who knows where else. Essentially, when someone buys something from you, you would transfer that profit to your friend's company in the low tax country by paying them for intellectual property that you needed to use to run your business. For example, let's say you make $100,000 in a high tax country. You would turn around and send that money to your sister company in the low tax country by purchasing your own intellectual property and then reporting that to the IRS as a business deduction because it was necessary and ordinary to keep their business running. That's actually the broad definition for things you can business expense according to the IRS. See it for yourself. To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your industry. A necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. You see the broad language they use here and the kind of gray area it can create for businesses? And just to clarify, you deduct your business expenses from your overall income over the year, and then whatever you have left is your profit. But if you business expense all of your income, then you don't have any profit left over to pay any taxes on. And that's essentially what these companies are doing. Now you might be wondering, why don't businesses keep some money and pay the tax? If I told you I was going to give you $10,000, but you have to pay $5,000 of that in tax, or you can spend that $10,000 ideally on an asset that holds its value or preferably grows its value like real estate. You would buy the asset, spend all of your money, not have any money left to pay taxes, but you still own something worth that amount of money, and it just holds its value and you can sell it back later. When it comes time for the company to declare their profits at the end of the year and pay their taxes, they report that they don't have any profits. The money is now moved into the country with the lower tax rate, and that's much nicer for everyone. But like I said, it doesn't end there. You can do this multiple times. Move it from the US to Ireland to the Netherlands, and by routing profits through these complex and obfuscated legal structures, these businesses end up paying very little or no taxes at all. Moving on to something called depreciation. No, I'm not talking about how you feel on a Monday morning either. In the business world, depreciation is a way companies reduce their taxes by spreading the cost of an asset out over its lifespan. Imagine you buy a brand new toy car. You play with it a lot, so over time it gets a few scratches, maybe loses a wheel, and it's not as shiny as it once was. It's depreciated. It's lost some of its value. They say things like their equipment or buildings aren't as valuable as they once were, so they shouldn't be taxed as much. Now, the next one here is stock options for compensation. So, about those big shot CEOs, you ever wonder why they accept those $1 salaries? Let me be the first to say, it's most likely not out of the goodness of their hearts alone. What these CEOs do is get stock options as part of their compensation. But the thing is, these stock options aren't taxed until they're sold. And then they're taxed at the capital gains rate, which is typically lower than income tax. It's a win-win for them, unless the stock tanks, in which case they usually buy back their own stock to inflate the price while laying off a bunch of other people. Imagine if your boss said, I can't give you a raise, but here are some lottery tickets. If they win, it's all yours. The CEO might not get a big salary, but if the company does well, they could be worth a lot more. They also have things like performance incentives. We've seen that with the Miller Knoll CEO and her compensation. Now the next one here, research and development tax credit. It sounds nerdy, I know, but it's just a way for companies to get tax credits for doing what they're supposed to do anyway, innovate. It's like getting extra credit for turning up to class. And the best part, there's no limit on how much a company can claim in R&D tax credits. I mean, maybe there is, but how gray is that limit? Now, the next one is debt versus equity financing. Simply put, it's sometimes cheaper for companies to borrow money than raise it because interest payments on debt are tax deductible. It's like choosing to rent a house because you can write off the rent instead of buying and having to pay property tax. Sounds a little bit backwards, but it's just another way businesses save on taxes. Well, imagine you're deciding whether to buy a car or just keep using Uber. Buying the car is expensive and you have to pay for insurance, gas, and the maintenance and all that. But with Uber, you only pay when you use it. But all of the other costs are someone else's problem. Companies think about debt and equity financing in a similar way. Borrowing money, like using Uber, is often cheaper for them than raising it themselves. The next one here is using losses to offset income. This one's pretty straightforward, but companies can use their losses in one year to reduce their taxable income in other years. Companies like to do this with equipment. Just like you can deduct the cost of a business lunch on your taxes, they can deduct the cost of the lease payments. But what's really interesting is that businesses can create subsidiaries or sister companies, so it's all still owned and run by the same people usually. One of these businesses will loan money to a sister business, and the business that gives the loan can deduct that money at the end of the year. But the recipient of the money doesn't have to report it as income because it's not. It's a loan. Now, of course, this is something the IRS know about. They watch out for if people try to misuse this and do shady stuff. But of course, it doesn't stop it from happening. I guess it really comes down to how expensive are your lawyers? How creative are those accountants? How much money these companies have to make it all legitimate. Now, the next one here is called accelerated depreciation. This is like regular depreciation on steroids. Instead of spreading the cost out of an asset evenly over its lifespan as it depreciates, companies can write off more of the cost in its earlier years. Now, I know that was a whirlwind tour of some of the sneaky yet, I guess, perfectly legal ways businesses and wealthy people avoid and lower their taxes. Thank you so much for watching. And if you found this video enlightening, informational, helpful, hit that like button. Be sure to share it with your friends. Click subscribe if you'd like me to break apart more of this corporate corporate nonsense for you. And once again, I'd like to say thank you to today's sponsor, Extra Wallet. They're giving me another shot, and I am infinitely grateful. So be sure to check them out with the link below and use my code Fluke for up to 35% off. Father's Day's coming up here soon. Anyways, thanks so much. I hope everyone's doing well, and I'll see you very soon.